As my wife and I watched the recent presidential debates, we found ourselves being very tense and uptight. We had to tell ourselves to breathe deeply and try to relax. And you know what? We're not alone. There's actually a thing called election stress disorder, and people on both sides of the political divide are feeling tense, anxious, and overwhelmed right now. Election years can be filled with uncertainty as developments surrounding the candidates, platforms, and predicted effects on the economy and markets dominate the news. Many financial advisors out there suggest that you should be making adjustments to your portfolio based on the latest polls. Many of these advisors make money based on their clients' fear and greed. They often make money based on buying and selling products to calm their clients down. So the question is, should you let this stream of political information influence your investment portfolio? A lengthy history of empirical research suggests not. At Intelligent Investing, our passion is to minimize financial stress to maximize your life. We attempt to be a buffer between headline news and your portfolio. Elections matter, just not in the ways you might think to an investor. Elections hold great importance in upholding the U.S. tradition of democratic representative government. However, the election's impact on market returns has historically proven to be negligible, as shown in the following chart. This chart shows a 60% stock, 40% bond portfolio's returns during non-election years in gray and election years in purple. The average return during the election years was 8.9%, and the average return during non-election years was 8.1%. So as you can see, the chart shows no significant statistical difference. Well, what about volatility, some of you may say? Isn't there more volatility as we head towards an election? Well, given the horse race nature of political campaigns, as we've seen, you may think that in the months closest to an election, there's a noticeable uptick in volatility. However, in actuality, the opposite has been true. As you can see from this chart, from January 1st, 1964 to December 31st, 2019, the Standard & Poor's 500 or S&P 500 index's annualized volatility was 13.8% in the 100 days before and after a presidential election, which was actually lower than the 15.7% annualized volatility for the whole time period. The bottom line is that markets tend to ignore elections. Elections are one of those events that generate lots of headlines, but that should not sway you from following the financial plan you've created. It's understandable to have concerns about the election, but as far as your portfolio and the markets are concerned, history suggests it will be a non-issue. Part of successful investing is understanding what you can control and letting your emotions take a back seat. By maintaining perspective, discipline, and a long-term outlook, you can sustain progress towards your financial goals despite the short-term uncertainty that events such as elections can create. If you don't have a financial plan with your goals in place and a portfolio that supports those goals, please feel free to reach out to us. We'd be happy to have a short call with you to see how we can minimize your financial stress to maximize your life. Thanks so much for your time, and please be sure to vote.